Hi, my name is Daniel Dalmolin. I'm a financial advisor with Global Financial Consultants. Before I became a financial advisor, I had a corporate career in financing the supply chain. Over the years, I've advised many people on how to better prepare for their retirement and how to better prepare their financial situations going through their career in all walks of life. After talking to many clients over the last few weeks and months, and also talking to participants in the market, family members and friends, there's one theme that keeps on coming up is uncertainty. There's a lot of issues around interest rates. Are we seeing interest rates going up further? There's issues around inflation. Is the price of goods going up more? Mortgage rates, is my mortgage going to increase or decrease in the near future? Also, there are considerations around GDP numbers. Are we going into a recession? Are we coming out of a good boom time, and is it going to level off? Is it a soft landing? Is it a no landing? Is it a hard landing? We don't know. The main thing that we need to propose to all of our investors and clients is to stay invested. Do you know that if an investor could time the markets, they wouldn't be doing their day job anymore? What they would do is they'd say, hey, at a specific date in the future, I know exactly where the market's going to be. They'd load up on options. That would be it. They wouldn't need to work for the rest of their life. But nobody can do that. It's not possible to time the markets. It's not possible to time the capital markets, equity markets, interest rate markets, foreign exchange markets. So if somebody's telling you that this is the bottom of the market, or this is the top of the market, or we should enter here, we're going to exit there, please don't take their advice. In the following chart, I want to show you what the performance of the major markets have been, financial markets, in the last 30 years. For the last 30 years, US shares have increased 10% on average every year. Australian shares have increased 9% on average every year. Australian bonds have increased 5.9% every year. And the CPI has increased 2.5% average every year. So if we have a look at this, we can see that as long as you're invested in the markets, over the long term, you can improve your financial position. We are not day traders. We are not traders in the share market. We are investing people's money for the long term. In the next chart, I want to show you how you take volatility out of your investments the longer you stay invested. If we're invested in for 1 year in the markets, we don't know. Our prices or our values in the markets might be up and might be down. But the longer you stay invested in the markets, the lower the volatility and the gains average to the upside. People often say to me, hey, how about if we invest in January, we cash out in July, and we enter the markets again in November? This is an interesting case study because all of the markets that had their bad months have always been around October or November, and people want to miss out on those months. But if we take the average of all years in the last 30 years, and if we remove the top 10 trading days of the year, as you can see in the next chart, your returns will be halved. If we go a step further and we say, okay, then maybe there's a specific month that in certain years haven't been performed or haven't done well, and we don't invest in that month, yeah, that could be a case study. But if we go back to 2002 and remove 1 month, a better month, out of all of our years, it'll reduce our average returns by 0.5% to 0.8%. And if we take the 2 best months out of the year, it'll reduce our returns by 1%. If we're going to invest using this sort of strategy, can we be certain that you're going to remove the correct month out of the year? Because sometimes, if you look at 2022, the worst month was January. If you look at this year, maybe it was March. So how do you forecast which month to take out? If we have a look at, again, staying on our theme of staying invested, overall, the last 30 years, let's say US shares, US shares have had an average return of 10%. But if we were going to say that we only invest in certain years and other years because they might be toppy in the market or they may be not looking too good, we remove those years, maybe you remove the good years. In the best years, I think the US market has increased about 22%, and at worst is also about 22% over the last 30 years. So it's very difficult for somebody to say, hey, maybe you should be out of the markets this year, or should we be out of the markets this month, or should we be out of the markets this week? So the theory for long-term investment is still stay invested. One of the other reasons to stay invested is to stay ahead of inflation. If you have a look at current bank deposits here in Singapore and around the world, inflation is tracking well above our fixed deposit rates. So if you were going to put money away into the banks in fixed deposits, maybe we're looking at money not keeping up with inflation. When we have a look at the types of assets to hold, we generally suggest that we have a mix of ETFs, that means funds, of equities, but also bonds. Because traditionally, when shares fall during the year, bonds increase, or when bonds decrease, shares improve. So to have a combination, now depending on people's risk profile, of bonds and shares in a portfolio is probably the best way for long-term investing. Thanks very much. I hope it wasn't too serious, that presentation, but long-term investment is a serious business. If you'd like any more information or you'd like to contact me, my details are below. I try and do these videos once every 2 weeks with things that come up or things that people talk to me about. So I'll be back in touch in about 2 weeks' time. Thank you for your time.